Alrighty, so welcome everyone. Today's session is going to be all about traps, liquidity sweeps, and how to use them to your advantage instead of getting trapped yourself. Traps are a very, very big part of my trading. Initially, when I first started trading, I used to get trapped quite often, right? Whether I'm going short or I'm going long, I used to find myself going long too close to the top and going short too close to the bottom right as things look like they're about to go for big breakouts or big breakdowns. I'm looking to enter into my position, and then fast forward a few hours or a few days later, and price is reversing hard against me, and I'm getting stuck in these trades that are underwater. So I kept asking myself, there has to be something that's going on here that's causing this, right? And just as me as a beginner retail trader, I'm sure there's a million others just like me who are doing the same thing. And if there are a million others doing just like me doing the same thing, then clearly there's something that is happening under the hood, right? Fast forward a few months later, and I'm starting to take note of the times where I would be going short when I first got started, and the times I would be going long. And instead, just being patient and watching what happens instead of participating. And I started to notice that indeed there are traps that are being set up, and there are participants that are getting swept and used as liquidity for the big boys, right? As I mentioned in one of the sessions, institutions need the counterparty liquidity in order to execute their positions. And a very, very good way of doing that is through traps where retail get really, really excited, whether it's to long a breakout or to go short on a breakdown, and they get trapped and used as liquidity. So, how can one identify those and do one of two things? Either one, avoid being trapped, or two, playing the trap. As of recent, especially in a more range like market, I think traps become very, very beneficial. It is also why you see a lot of dips get bought up and why you see a lot of rallies get sold. The reason for that is because every time we rally near the highs, sentiment gets really bullish. Everyone starts to go long, thinking the market is planning on a breakout. The retail trader gets used as liquidity and gets trapped, and then as the market pulls back, things reverse very quickly. It's also why you see, if you guys have heard of the saying before, staircase up, elevator down. Price takes, let's just say, 5 days to make it to the highs, and then in one day, all of that gets sold off. Part of that happening is because of a bull trap at the highs where everyone gets bullish near the highs instead of buying things off of the lows or off of a higher low, which is the way that I personally like to trade. Same thing happens vice versa. Every time the market pulls down into range lows, whether the range or the base is at the highs, right, or whether the base is at the lows, as price is red and pulling back for a few days, everyone is all of a sudden bearish and everyone is calling for a breakdown or some sort of head and shoulders pattern that you see everywhere. Some sort of everyone's posting bear flags on the moving averages, and everyone's just getting short way too late. They might get one day of breakdown, and then you'll notice that the next day we gap up and everyone's trapped short, and then those are used as fuel to the upside because when one participant is trapped, the opposite participant can use those trapped traders as fuel, right? Because we know that when someone goes long, in order to close their position, they need to sell, right? For every buy, there's a seller. For every sell, there's a buy. So when they are long, if they get stopped out, it means they have to sell their position. So that adds to the selling pressure. And if someone is short, in order for them to close out their position, they need to buy back their position. So that adds to the buying pressure. And that's basically kind of the mechanics behind traps, right? And how they work. They work both to the upside and to the downside. It just really depends on the type of market that we are in. For example, in today's market, both have been working, as I mentioned. Anyone that got short on October 10th lows got squeezed. Anyone that got short on the Nvidia earnings lows when the market kind of gapped up and then sold off all the way down to the lows got squeezed. Anyone that went short last Monday, or not last Monday, last Tuesday on the trend line break, squeezed the next day, right? And I'm sure anyone that opened fresh longs today, I'm talking about the index level here, is more likely going to get trapped and reversed very quickly over the next couple of days. Um, and this just happens more often whenever we are in a range, right? Because when we are in a range, price just bounces between support and between resistance. So you can kind of, there's a high probability that price will trap someone at the highs and trap someone at the lows, and then just reverse in order to stay within a range. In a trending market, traps are still present. They just show up in slightly different ways through undercuts. If you're trading longs, through undercuts of the moving averages, which is usually how I like to trade a trending market. I'm not a person that really buys high of day breaks. Instead, I'm looking to go long off the lows. And an example of a trap in a trending market is an undercut. If you guys have ever heard of a undercut and reclaim of the moving averages, that is essentially what a trap is. And same thing happens in a downtrend when market pops above the moving averages as we rally into declining moving averages, pops above it and then fails back again. That's also a trap. So traps happen in all types of markets. They happen most often in a range, which is the type of market that we are in today. And understanding how they work can really make you a killing, because you can simply trade the range with a lot of success and look to catch one to three, 4 kind of day moves that work pretty well, and they're usually stress-free. So today's session, we'll be talking about markets, right, and how they move to where orders exist, what liquidity is, and how resting stops and breakout orders kind of work, and how price seeks execution rather than just moving randomly. Price likes to move to areas where liquidity is present, and how certain highs and lows are liquidity magnets. So where does liquidity actually sit? Keep it simple, guys. These are also kind of, instead of, another way to frame this is, where do you want to mark out your levels? Swing highs and swing lows, trend line breaks. So if you're in a downtrend, you want to look for the upper trend line to break in order to trade the breakout out of that. And if you're downtrending, you want to look for the upper trend line to break to trade the breakdown out of that. That might have sounded confusing. I'll show you guys on a chart at the end. Previous days highs and previous days low. That one is also pretty important. And everyone sees it levels, just like psychological levels, right? That's why a lot of these parabolic shorts like to top out at psychological levels. If you take a look at SMCI in the past, MSTR, I thought that silver was going to top at 100. It didn't, but instead, I think SLV, the ETF, topped right around 100. GLD, the gold ticker, the gold ETF, I think, is it S&P? The S&P gold ETF, I think it's going to top out at 500, which is what it is sitting at right now, I think, in after hours. What else is there? There was a few others. But yeah, psychological numbers are definitely important, and just levels that everyone really sees. If you can see it and it's a very obvious level that has been respected multiple times in the past, then chances are liquidity is there. So buy side versus sell side liquidity, those are just fancy words. You guys can choose to ignore them. But essentially what they are is, a buy side liquidity is stops from shorts, right? That's where, because when someone is short, they must set a stop, right? Can I draw on this? Let's try something here. No, I can't. Just do that. I can't. Yeah, I can't. Okay, that's fine. Oh, actually, no, I can. Right? Hold on, guys. Give me a second. Yeah. Why does it do that though? But yeah, so if someone is short, right? Let's just say someone goes short right here. What they need to do, right, now their position is in profit out of this level. If price, they're gonna set their stop somewhere, let's just say around here. Okay, guys, never mind. This is horrible. We'll just do it on TradingView. But yeah, so buy side liquidity stops from shorts, breakout buy orders over a specific breakout level. and it usually sits above some sort of high. Sell side liquidity is the same thing, but vice versa. Stops from longs, break down sell orders, and sits below lows. So what are liquidity sweeps and how are they explained? Liquidity sweeps and traps basically represent the same thing. They just have different names, but essentially they both lead to the same outcome, which is a certain participant going underwater. And what I mean by underwater is going red on their position and is forced to exit for a loss, which can add fuel to the move that is currently happening. So a liquidity sweep, simply explained, price pushes slightly above a level, right? Stops begin to trigger, orders flood in. Usually you start to see smart money fill into that, right? Because they need they need that liquidity, right? And then price begins to reverse or stalls, right? Always keep in mind you can only consider a sweep once price fails to confirm beyond the level, whether it is above or whether it is below. Usually leaves behind some sort of upper wick. I like to call liquidity sweeps just wicks. So if a candle wicks through a level and comes back down, I call that a liquidity sweep. But if price trades above a level for a couple of hours or a couple of days, depending on the time frame, and then falls back under that level, I like to call that a trap. You guys can call it whatever you want. At the end of the day, it just represents the same thing. It's just that a liquidity sweep usually happens a lot quicker through a wick instead of an actual kind of catalyst or a larger move that happens, right? That actually holds above a certain level or below a certain level. So liquidity sweeps, I like to use them a lot intraday as well. Everything that I'm talking about here in regards to traps, obviously we want to focus on it on the daily time frame because as swing traders, that's where our main bias should come from. But the same thing works when looking at an intraday session, right? If you have a low of day, for example, a lot of my long entries, I like to enter them as price sweeps the previous day's low. So I have the previous day's low marked out. I'm waiting for a price to pull into that low, ideally trades below it for a couple of minutes. And then I start to see orders hit the market. I start to see volume pouring in. And then as price begins to reclaim that level, I'll buy into my position and risk that low. When I do that, my win rate is usually going to be a bit lower because you're technically going against the intraday trend, given that it must have been in a downtrend to sweep the previous day's low. However, your risk to reward increases a lot. And the style of my trading is I'm focused more on risk to reward instead of the win rate. And I think everyone should do that. I don't see a point of focusing on a higher win rate and a lower risk to reward. That to me that doesn't make sense. Instead, I like to have a lower win rate, however, a much higher risk to reward. And with a much higher risk to reward, I can also do another thing, which is my stops are very close to my entries. So if I'm trading a sweep of the previous day's low and I'm entering as price reclaims the previous day's low, then my stop is usually about 5% away when looking at options, maybe 10%, depending on the expiry that I'm looking at and how well the premiums move. But generally speaking, my stop is very close, and that allows me to get a very big R multiple. And the R multiple is just your risk to reward. So if you're risking $1 to make 3, that's a 3R, right? I like to go for that and above. So I'm risking 10%. I'm looking for a minimum of a 30% win and much higher from there. But yeah, so when trading liquidity sweeps intraday, you are able to do that because your risk to reward is large. You might be losing more trades than you're winning, which is fine. I don't think anyone wins more than they lose from talking about the amount of trades that they take. However, your wins just must be 3, 4, 5 times your losses. You do that, you'll be profitable. So just something to think about. But yeah, liquidity sweeps, you can just call them the upper wicks or the lower wicks that just pop above a level and then fail back down. I like to think of traps as ones that actually have a lot of trading above that level. And usually traps can lead to a bigger failure because with more trading happening above a level, that's more participants being trapped, that's more smart money filling into those orders, and that just leads to a bigger move since there are more participants. A sweep, however, that happens very quickly is usually going just to quote unquote hunt stops. I don't think hedge funds and big money actually look out for retail stops. I think that's just what, I don't know, some sort of course seller probably came up with. But it's just something to think about, right? Like, where does the average trader place their stop, and where can we see some orders flood the market? Not that they're gonna make that big of a difference, but when there's enough participants looking at the same thing, it can make a big difference. So, how do you differentiate between a real breakout and a liquidity sweep, grab, slash trap? This is a very, very big and important part of the session because you guys need to understand not to trade, not to go short at any breakout that might feel a bit weak to you guys. This is one thing that I was doing back in my day when I first started to learn how to really trade the downside. I used to automatically think that majority of breakouts are fake and majority of breakouts are traps. That is not the case. That is not how things work. There are failed breakouts that happen quite often, but it always depends on the context of the chart. For the millionth time, guys, you can't just trade something based off a candle or two. You need to use the overall context of the chart, pair it with the higher time frame alignment, pair it with what the sector is currently doing, and what the index is also doing. That's how you get um, to say whether something is more likely to be a real or failed breakout, right? You need to be using that as your foundation and then diving into the technical analysis of the current day or the current time frame that you're looking at and to look out for these things. A real breakout will have confirmation above the level, right? Price will reclaim that and accept it and move well above it. You're gonna get that expansion move, and you're usually gonna get continuation as price holds above that level. It might pull back for some time into that breakout level and then continue out higher. That is a real breakout that will likely continue for days or hours depending on the time frame that you're looking at. However, on the other hand, a liquidity sweep is when price moves into a breakout and you automatically see selling hitting the tape, you automatically see volume starting to pour in, and there's a large upper wick that is above you. That is a liquidity sweep, right? And that is where price essentially swept all the new buyers that were looking to trade that breakout. It usually happens very quick and you can't really trade it, but what you can do is wait for the confirmation after, right? This goes back to the point that I was just making earlier. Don't go blindly shorting any breakout or longing any breakout for the same matter. You always wait for the confirmation after. Breakout occurs. Does it hold? Does it not hold? We don't know. It's currently moving what looks to be a breakout. However, I'm waiting for the next couple of days to see what happens. Is price slowly pulling back and setting up for some sort of continuation, right? Or did sellers flood the tape and is price now starting to kind of look like a failed breakout? And am I looking to trade a lower high that comes from there, right? You need to always be thinking of that and looking to trade the move after what looks to be a breakout. Whether it is you going long or going short, you still want to wait. You don't want to just be buying any fresh high that is made. That is how you get cooked. Even if the breakout is real, you're going to be buying expensive premiums and you're going to be hitting the ask and your stop is going to be very wide, and that's just bad trading. Instead, you wait for the pullback and then you see and you take a look deeply on the pullback. Was there volume? How was price shaping up? This is all after already reading the overall context of the chart and what market cycle we are in and what the index and the sector is doing, right? We know this that's your foundation, and then comes all of this, right? If you see the pullback has very high volume, there was a lot of volume that came in at the highs after the breakout. Price is failing under the level. Pops on the lower time frames are kind of getting rejected. We're seeing some sort of weak orbs begin to form. Those are all things that you need to be taking note of and paying attention to in order to know whether something is an actual breakout or a liquidity grab. Some things might even look like a real breakout for a couple of days before reversing later. That is not necessarily something that you can really predict. There are a lot of things that happen like that, but the only thing that you can do to put yourself in the highest probability of success is use the context to your advantage and understand the type of environment, conditions, and what the sector slash index is doing, and making sure that you are aligned with that and not against it. So liquidity crowds, fast push, instant rejection, right? Upper wick and a failed close, so a close back under the opening print, which would be important. I think you guys have heard me say this by now multiple times. Most of my short attempts will come under the opening print. I do not like being short above the opening print. Sometimes I will be if it's some sort of parabolic short or some sort of mean reversion, but those don't happen often. Majority of my shorts come as we lose the opening print, and then I can base my risk off of that. Just like how when I was mentioning basing my risk off of liquidity sweeps and the risk being super tight of around 5%, the same thing happens when I'm trading short and I'm going short after a break and base under the opening print. I can risk the opening print reclaim, and that gives me about a 5% stop if I am wrong. And then if I decide to stop and cut it for 5%, so be it. It's a 5% loss. Very manageable, very good trading. If the price decides to break under the opening print yet again later in the session, I have no issues buying it back because I just took a 5% loss, which is nothing. Right? But if you're taking 30 to 40% losses, you're definitely going to have issues buying something back because you just lost a good amount of capital. But when your losses are tight, right, you can attempt something multiple times until it does work out. A 5% loss, 4 times the same thing as one attempt with a 20% loss, right? Just find kind of the balance that you like with attempts and stops and use the one that works. For me, I like keeping a very tight stop. Sometimes it's too tight and that ends up biting me back. But from what I've seen, I like keeping my losses extremely small and then always look to buy things back. No issues doing that. But yeah, so break above or below holds briefly and then fades quickly, and volume begins to spike without progress. Key here, you see that volume increase. Doesn't have to be anything that is exceptional, right? I'm not talking about insane volume, but certainly a definite volume increase, at least over the last couple of days, right? So over the last 5 to say 10 days, you are seeing that volume, some higher volume today than compared to the last couple of days. That should be key. Doesn't have to be anything exceptional, but just an increase in volume without price reflecting that. Then you can say that institutions were likely selling into those highs. Why do breakouts even fail at the highs often? The reason for that is because the breakouts that you're looking at are usually exhausted and extended moves, right? As I mentioned, another big part of identifying which breakouts are good to long versus which ones are bad is by looking at how extended a name is, whether it is breaking out of a base, whether it's breaking out of an accumulation, whether it's already been an uptrend, right? You need to take note of that. Liquidity is going to sit above, not below, and late buyers provide the exit liquidity. As I mentioned, institutions like to sell into highs. They don't like to sell into lows. When price breaks down, that is something different that is happening, which we will discuss later. But when institutions like to slowly exit out of their position and distribute a name, they will sell into highs. They will not sell into lows. And that's why within a distribution range, you see those large upper wicks with a lot of breakouts failing because it is them institutions that are using those highs as liquidity events and targeting that liquidity to execute their orders. They like to sell into strength and like to keep a big piece of their profits. Again, that doesn't mean go ahead and short any new high that is made in a distribution. You can get cooked very easily doing that because a lot of times something might look like a failed breakout and might look like a distribution, but guess what? A high continues to be taken out. That happened to me recently on MU. If you guys remember a trade attempt that I took, I think it was 2 weeks ago, I went short right before the day before the director decided to buy stock. The stock gapped up against me 5% the next day. But looking back at it, was it a good trade? Yes. Was it the best trade attempt? No. I didn't get enough confirmation to be short. And my execution was not the best. However, it was still a system trade that set up for a mean reversion, just didn't come. But because I was able to slowly bid into my puts on highs that failed, I was able to get my execution as close to high of day as possible, right? And that gives myself a small room for error, right? If something pops slightly, and then I'm gonna be cut out of my position for a small loss. But if price decides to reverse into close and get a weak close, then I'm up in my position, and this could turn into a big win. That is how I like to short, and how I like to think institutions also like to exit out of their positions by selling these new highs that are being made that end up reversing and failing by close. A key point here is the word exhausted. You do not want to be shorting a breakout early. You want to, for example, let's just say the MU trade I was talking about. And a foolish version of me, what he would have done, or a more beginner trader would have done, was the next day as we gapped up, they would have doubled down. Right? Let's just say market opens, they're down 30%, they double down, right, and they hope for some sort of reversal. That is exactly how you get cooked, right? Because when a catalyst hits, you can never know when that catalyst move is gonna stop. Never. It is impossible for you to know when the catalyst is gonna stop price from moving higher and price is gonna begin to stall out. Very similar to how the Greenland news that hit last week. No, if anyone went short right at the Greenland news came out because they thought that this is gonna be sold, they would have gotten cooked the next couple of days easily. The person who would have potentially profited was it, or kind of will be, sorry, the person that will profit off of that news being some sort of liquidity event is going to be the person that waits for exhaustion over that high, which is what I'm currently doing right now with my Nvidia attempt. So I got one win initially on the Nvidia short before the Greenland news of 100%, and then into the Greenland news I stopped out, and then reattempted it the next day, stopped out, and then today I attempted it again, but very light size, something that I can triple down on if I like the action that I'm seeing. But however, now we are starting to look at least more exhausted above the high, right? As price makes these new highs but fails to hold new high of day and begins to instead pull back off the highs and get some sort of weaker close. I got the weaker close that I wanted. My position was up, I think, about 15%, but I got time on those, and not a position that I'm worried about, something that I'm willing to add on. But this is how I can set myself up for success when looking to short some sort of failed breakout or some sort of exhaustive move, because I waited for the exhaustion above the catalyst high. If you take that same idea and apply it to MU, you'd be the person that would be looking to trade MU would have been looking to go short a few days after the director buy, not during the same day that the director buy, because you cannot time when a catalyst stops to affect price. Same thing that happens to the downside, right? If bad news hits at the lows, you do not want to be the first guy to buy the dip. The first person that buys the dip is likely going to get shook out. Happens more often than not, right? Bad news comes in, stock begins to sell, dip buyers pour in, next day price gaps down, dip buyers get smoked, right? They get shaken out, price begins to look exhausted to the lows, right? After breaking a low below that, and then price begins to stall out and slowly begin to reclaim levels. Then fresh buyers that enter the market then, right, after price dips below and gets exhausted below the bad news, those are the ones that can be profitable and they can risk that low that was just made. That is way better trading than just going and shorting any sort of impulse move due to a catalyst, or even not a catalyst, right? You don't want to be a guy that's just shorting any impulse move to the highs and hoping that it reverses because price looks extended. No, big no. You're buying premium that's going to get fried very easily with volatility, and you're not going to be able to tell when price wants to stall out. So wait for the exhaustion away from the impulse move, whether it is a catalyst or not a catalyst, and then decide whether you want to short that failed breakout if it does decide to fail or break down or not. So bull trap versus bear trap, the difference, I think it's pretty easy to tell. A bull trap is a breakup of the highs, triggers short, oh my god, I can't speak. Short stops, triggers short stop sellers, right? And they buy back their position, but price fails to hold, and then price returns inside a range with a large upper wick. A bear trap is flush below the lows or into some sort of level. Stops begin to trigger, sharp reclaim, price accelerates higher with volume. Funny enough, a very good example of bear trap is the gold run that just happened. Now you guys might be thinking, wait, what? How could there be a bear trap in a parabolic move on gold that has just gone up 5 days in a row? I'll show you exactly what I mean and why I personally stayed away from shorting gold until today. So today was my first attempt on gold after it has ripped for 7 days. And I'm really happy with that I didn't attempt it earlier. Old me would have definitely attempted it this whole run up, but we don't do that stuff here. We are very selective traders. So I'll show you guys exactly how a bear trap worked in gold and how it led to price doing exactly what it is doing now. You could have seen it from a mile away, especially after the first trap. I'll show you guys the chart on TradingView right after I'm done with the slideshow. So like I mentioned, don't chase first breaks. Whether it is going long or going short, whether it's a failed breakout or failed breakdown, do not be first. Always think about what's that word? A trade-off between your fill and your confirmation. They're not going to teach you this in any Discord. I'm 100% sure of this. So guys, please pay attention. There is always a trade-off between your fill and... Oh my God, my brain is not working. What did I just want to say? Oh, confirmation. They will not... You cannot... Guys, I'm sorry. I can't speak. There's always going to be a trade-off between your fill and your confirmation. And you need to find the balance that you like. If you buy a very good fill, right, which means you are getting in at a very cheap premium, that means that you do not have as much confirmation. And if you do vice versa, if you're buying something with a lot of confirmation, chances are you're buying it with a worse fill. I cannot sit here and tell you which one is better, whether it's a good fill with worse confirmation or a good confirmation with a worse fill. At the end of the day, it comes to preference and what you're comfortable with risking. Try to find a balance in between the both, right, that you're comfortable with, and that is subject to the chart, of course, not just blindly thinking of it. Now, most importantly, don't chase the first move. Wait for the pullback or the pop that comes after. You might be thinking, well, what if the move just happens from the first break and it goes? Guess what? It left, right? That's fine. That's part of trading. That wasn't a good trade because you're not going to be the first person there. That is a bad trade. If price did not set up with consolidation after that impulse move, then it is not a good trade. I don't care about the outcome of the trade. I care about the process that led me to taking a position. And if the process that led me to take a position was me buying an impulse or shorting an impulse, then it is a bad trade automatically. And I do not want to be involved in that, because you take that over 1,000 trades, you're not going to be profitable. Instead, you focus on the process, and the process is you see impulse, you wait for some sort of consolidation, and then you look to trade that. Whether it's a breakout, failed breakout, breakdown, failed breakdown, doesn't matter. We are still focused on that. Let liquidity be clear, right? And see what price is doing when volume is hitting the tape, right? What is price actually doing? Are we confirming? Are we rejecting? Are we stalling? As we talked about in the VPA session. As I mentioned, wait for the reaction after the sweep. We are always waiting until after. Stocks don't just move up 10% and move down 10%, right? Things don't just move that easily. 9 times out of 10, they'll move 5%, they'll pull back 2%, and you'll be able to buy that. Or they'll sell 5% and they'll pop 2%, and you'll be able to short that. So always think about that, guys. Please don't be first. If a consolidation or some sort of resting days or resting hours don't come after an impulse, then don't trade it. We are focused on the process. We are not focused on the outcome. Price tells you intent after the order is filled, right? So you always want to wait to read what price is doing when the volume came in to see what's more likely to happen. What's most likely to happen? Will this move hold or will it fail? Is this breakout gonna have some follow through above, right? Or are we gonna pull back and fail? Key takeaways: liquidity sits where traders feel safe, or instead of safe, you can think of where everyone is looking at. So key levels that you mark is usually where liquidity is gonna be sitting. Don't think of liquidity as some sort of fancy word. I know it sounds a bit fancy, but it's just basically volume and where volume is pouring in. Sweeps are required for large execution. Sweeps and traps, same thing. Breakouts don't matter. It's the move that comes after that matters, right? The reaction to that, the reaction to the impulse, that actually matters. Traps are more often than not intentional and they are not random. They don't just happen because price decided for that. No, there are buyers that are waiting at low of day. There are sellers that are waiting at high of day. There are sellers that are waiting at all-time highs, just how there are buyers waiting at all-time lows. Traps do happen because institutions do need the counterparty liquidity. However, we are not just thinking that every move is a trap. We use market context. We understand the environment we are in. Some environments favor a lot more traps, just like today's environment within a range. Other markets that are trending don't have as many traps. However, some are present with undercuts and reclaims of moving averages and uptrends and rallies into declining moving averages that pop and fail on in downtrends. Those are all traps. You just need to understand the environment we are in. I need to also wait for the reaction after the impulse move happens and after the trap happens. You do not just want to be buying the first trap that you see. You want to wait for the reaction and the consolidation after the trap to look to trade it. Does that make sense? Q&A time, guys. Any questions? The fill might come after the confirmation. Yeah, so what I meant by that, I had a brain fart. Apologies for that. What I meant by that very simply is if you are buying a cheap fill, that means you are buying a position with lower confirmation. And if you are buying an expensive fill, so a more worse fill, then you are buying it with more confirmation. So you just need to find the balance between the both that you like and base your risk off of that, subject, of course, to the chart that you're looking at. So for a breakout, the consolidation is the orderly pullback and defend before rally again. Yeah, that is true. You do not want to be the first guy to a breakout. If price is breaking out of a level, right, and it's up 4 days into that breakout spot, I'll let it go without me. I'm fine with that. I'm not gonna buy something that's up 4 days in a row because it's breaking out. I'm gonna wait for 2 days of a pullback with some consolidation, and then I'll look to buy that if price looks good and if volume is low on that pullback. Let me switch over to TradingView. On a gap and go, would a orb entry be acceptable if the orb range is the stop? Personally, for me, I don't like doing that. I'll show you how I trade gap and goes instead. The way that I like to trade gap and goes is usually one, it needs to be a gap that leads to a breakout, right? So it's a gap that actually can push price up and above and expand it out of a compression, right? And the way that I like to trade it is, let's just say price closes right around here, right? And the next day we gap up here. If we thrust higher off open, I'm not gonna look to open a long here. That's a horrible trade, even if my stop is placed here. Why? Because chances are price can do this and I get shook out here. So instead, the way that I trade gap and goes is, instead I wait for some sort of, maybe price opens and consolidates, maybe even pops, and then I wait for the pullback and I wait to see what happens into this low here. Do I see volume pop in and I see some sort of hammer candle and I start to see price kind of turning off the lows, then I'll buy it somewhere around here and I'll set this as my stop. And it will be kind of sweeping the open and some sort of low that was made off of open. I'll go long there. And same thing happens if I'm looking to trade a gap and go to the downside. Let's just say price was here, we open up here, right? I'm not gonna go short down here. That's exactly how I get trapped. You guys will even notice sometimes that if you get some sort of move into close and then you get a gap down and a thrust lower off of open, usually leads to some sort of V recovery, because this gets kind of extended to the lows and that gets bought up and reversed quickly. So instead, what I actually do is, price is here, right? We get a gap down. In order for me to look to short this on a gap down, which I usually hate to do, but I'll look for a pop and reversal into the gap. A good example actually that I have of that is on a silver attempt that I had a couple of sessions ago. Back here. Unfortunately, it didn't end up working out, but this is what it looks like. So we got some sort of a small sell-off into close, right? You can see here, and then market opens down, or not market, silver opens down 3.6%. I'm not going short here. I just want to wait for some sort of pop, right? And I look to short it. You could use fibs if you'd like, from close to open, right? And look to short it off of that. You can use an EMA if you like, whatever you're comfortable with. I just kind of eyeball it. Sometimes I use a fib, but usually it's more so just eyeballing and waiting for confirmation out of that. And then for longs, I think Baba might have set one up. This one here is not a bad example, although I certainly would have liked it if it pulled in lower. But if you want to pull fibs and see where price stalled out at, not exactly at the discount, but somewhere close enough. But yeah, that's how I like to trade gap and goes. I'll look to bid the pullback instead of a high of daybreak. A gap and crap. Wait, so what's your question in regards to a gap and crap? Was Oklo a gap and go time from Jan 9? No, this one I would not look to trade a gap and go on, because this one was already up 41% into that gap up. The time where I'd be looking to trade a gap and go is when price is doing this, right? Price is consolidating here and it is getting ready for a breakout, let's just say to 188, right? So I think price is gonna move to, let's just say this is my target, up at 200, and I couldn't enter here, and the next day price gaps up to 185, and I still think it's going to 200. I'm not gonna buy it up here. That's a bad entry. Instead, I'm going to wait for a pullback into this gap, and I'll see what buyers do. If buyers begin to step in, I'll look to buy it here and trade this for a gap and go. Right, so this was the gap up, and this is it going. I'll set my stop right under this low. If price decides to pull down and break this low, I'll cut my position, and what I can do is wait for the gap fill, because sometimes price can pull into the gap fill and then and then reverse. So I'll cut it here for a 5% loss, and then I can look to buy it back here if I like to, if I see the action that I want to see. All right, this is all conditional. Like, I'm not just buying any of these moves. Instead, I need to watch for the price action. ANET, let me take a look. Yeah, technically yes. This did gap up, pulled back, a little pulled back deeper than I would have liked it, but this one was also running up into that gap up. Instead, I want to see price consolidating into the gap up, and then I'll look to trade that gap up. But yeah, so the thing that I was talking about on gold, the bear traps, right? So gold was looking extended right from back here. From Jan 14th, about 2 weeks ago, gold was certainly looking more extended than not, right? What happened from there? What happened from there was price, if you go down to the hourly, you can see it more clearly. It had quite a few bear traps, starting from back here. We had bear trap number 1. Price pulls back here. Sellers begin to pour into the tape, thinking this has topped out and is going to break down. Reverses, and everyone here is underwater. Price then gaps up the next day, and everyone that was short here stops out, adding more fuel to move higher. Same thing happens again on the 21st, and look how that squeezed out. And then the same thing happened yesterday with another pullback that gets bought up. As price breaks above high of day, you get a total squeeze out. And then I think that might have even happened today. You can count it on the earlier in the day or even into FOMC. And I'll admit, I was one of the ones that got trapped here. Okay, I'm not afraid to admit that. I still think that the setup was definitely valid. But I was lighter sized and unfortunately ended up getting squeezed out. I still do hold some of mine. I was just down 20% and it was a lotto attempt, so I'm just risking the premium that I paid. But yeah, and then look what happened in after hours, squeezed out even higher. So everyone that was shorting all of these pullbacks was getting smoked. It is also the reason why I don't like shorting into breakdowns. I don't like going short on the break of low of day, because this will tend to happen. Instead, I look for an exhaustion above the highs. I look for a sweep, and then I look to buy into that. But yeah, those are certainly very good examples of bear traps. And if you go to the daily, you can see it also here slightly more clearly with these lower wicks. So trap 1, trap 2, 3, and then some today. And this chart is just absurd. There's the futures. My focus is here tomorrow, no doubt. It's pretty crazy how at 5K, which is where everyone expected it to top out, and price was extended into 5K, and now we are 500 points above that. Insane. Without a doubt, some of the craziest, probably is the craziest parabolic short I've ever seen. You guys don't know what's also crazy? Last week was the largest gain on gold throughout this entire run up of 8.5%. This week we beat that by 4% of 12%. In terms of getting the best fill on your contracts, could you provide a description with an example? Sometimes a pullback comes cheaper with lower Greeks and stuff. Yeah, so it depends on the trade. that you are attempting. On mean reversions, I usually want to see. Let's just say I'm looking to short a mean reversion, not a parabolic short. A parabolic short moves slightly differently. Um, the gold and the silver action that you're seeing now is not going to be action that you see very often. Actually, in fact, not at all. So if you were kind of confused with the premiums about those, then I don't blame you. But that is something that doesn't usually happen when spot moves higher and put premiums also move higher. But generally speaking, the way that I like to execute to get a good fill on a mean reversion is I'll wait for some new high to be made, right? So let's just take a look at MU here. Um, Actually, I don't think MU is the best example. Let me try to think of an example off the top of my head. Maybe in video. Actually, let me try describing it. So the way that I would look for it is instead of me, let's just say price is in an uptrend, right? And price is extended and I'm looking for price to pull back off the highs for a mean reversion. I'm not going to be going and entering here, right? As price pulls back and makes a new low, I'm not going to be pouring short into here. Why? Because I can get trapped and price continues at higher. Instead, the way that I like to do it is I like to mark out the high that was just made. And when price makes a new high here and begins to stall out, I'll start buying into my puts here. And then I'm waiting and seeing, do we get confirmation? Do we begin to sell off? And then maybe I could look to add on something, some sort of lower high. Or does price continue at higher? And if it does continue at higher, but also does the same thing of just slightly moving higher, slowly moving higher, and price not really confirming, then I'll look to bid into these puts again. Because keep in mind, when price moves higher just like this, puts are obviously what losing value. And as puts lose value, right, the premiums decrease and I can get filled at the bid or at least close to the bid, right? So instead of buying a put contract at, let's just say this, the bid is at 200 and the ask is at 210. If you're going and buying puts down here, you're gonna have to buy the ask more likely than not because price just pulled back into that and the premium was rising. However, if you're slowly placing an order to buy it at this high, you can actually buy premium that is very cheap and get a very good fill. However, you have lower confirmation because we don't know that this is going to stop out here. We just have a good fill on our sides. Does that make sense? No worries. Sounds good. We'll be talking more about execution next week, by the way, and how to actually position into these trades and how to buy into contracts and all that. Sometimes the price keeps falling, but premiums hold up fine. Yeah, that does happen sometimes, and usually it's your lucky day if you're positioned in that. That happened to me with silver. Price moved up, and my premiums moved up. Yeah, definitely. That was one of the craziest moves I've ever seen. You guys have any more questions? I start from these enters when others And other a-holes are all puckered up. When I told him that, he said, yeah, it may seem that way, but I look for confirmation those times, not just blindly going pulse for cheaper fills. Yeah, exactly. You need to make sure that price is also showing that it's not just that you're buying blindly into cheaper contracts. But it's pretty crazy to think about sometimes how easy it is to trade the other side when most are looking to trade, whether it's the long or the downside. It happens so often. Usually there's multiple attempts and you need the gut. I like multiple losses, even if my thesis is correct. At the end of the day, it's preference, right? It's not about having the guts to do it or not. You obviously do need to have some gut to attempt something multiple times. But at the end of the day, a 5% loss four times is the same thing as a 20% loss once, right? Just keep that in mind. So at the end of the day, I took four trades, you took one trade, we both came out with the same P&L. It's just more so about preference. If you don't like to attempt something multiple times, then sure, attempt it once. But to me personally, and the way that I've seen success is through multiple attempts. I think that's the way to go about it. But at the end of the day, trading is more of an art than a science. There certainly is a lot of science to it. But I could be doing something and another person could be doing something else, and we both come out with the same result. Is anyone looking to short gold tomorrow? No? No one? I'm certainly excited. If you guys are attempting this with me, best of luck. I do think that this can be a massive, massive trade, without a doubt. And I really do think it's gonna top out tomorrow, if not tomorrow, after tomorrow. 100% gonna top out? I don't know. It's certainly worth the attempt though. I'm thinking to grab February 6 puts because I do think we can get something similar to this, where we can gap down over the weekend maybe. And I think, I mean, I'd love to catch this down to the 8 day. I think no, I think I'm gonna be leaving silver alone. I've took my attempts on this. I don't see a point to try this. Whenever you do see a climactic top just like this, the bulk of the move has happened, right? Even though price is back up, the speed of the first move that happened is likely not going to be the same if silver does top out here again tomorrow. However, gold hasn't had that, so the speed is more so going to be focused here. Yeah, they definitely are juiced just because of how crazy this move has been. IV is definitely inflated. But let me check. I had them marked out. It depends how we open up, but I think it was the 460s, which definitely is far out the money. If we're about 505 and after hours, 460 is about 8% away. But yeah, 460s is I think what I'll be taking. They're currently at 3. They're around 330 a pop. If I can get them close to 280 tomorrow, maybe cheaper, then potentially. I don't know. I don't want to overthink it too much. I'm just gonna market's gonna open. I'm gonna buy some puts, and I'm gonna leave size to double down. Intraday, and I'll look to take it from there. Momentum or velocity? What weighs more? Velocity. Because when trading options, you need velocity, right? Momentum is usually about how far price moves. Velocity is about how quick it moves. With options, especially shorter dated, you want that high velocity so that the premium actually juices. So in the short term, you want to be more so about how quick a move can happen instead of just the direction, how far it can go. I was looking at 475s, and yeah, they are definitely expensive. We'll see what they open out tomorrow. I mean, we did get a pretty big overnight gap. Honestly, I've never seen a move of this. Like, I've never seen a move this big. So I have no idea how the premiums are going to be priced tomorrow. And that's if we don't sell overnight. If we sell off overnight, then trade's going to be off the table for me. But like I said, I do have some weeklies that are um, basically lottos that I'm risking the premium paid. Yeah, Tesla does look fadeable. It did just report earnings. I am in an ARK short, by the way. Um, I just drew this out kind of a way that you can kind of look at it. Not so concerned about this kind of head and shoulders look. I'm more so just focused on just simply this break of trend line and it being weak compared to the to QQQ, with it also being very very consolidated here against the moving averages. But also just a starter, you obviously can't size heavily into Tesla's earnings as it is the biggest holding. But I certainly do like the look of this for a move down into the not October, November lows. Yeah, I don't really track the dollar. I'm not gonna sit here and act like a dollar expert. I've never traded the dollar, and I do not know what's gonna happen next. Could we bottom down here on whatever catalyst it was that dumped us? I think it was Trump's comments, maybe. But I'm not gonna act like an expert in this field. I have no idea what the dollar's gonna do. You held up at the high with huge volumes. Can we look at it? End of the day trade. I don't understand your question. How can I enter on a day like January 2nd? Do you have an approach for that? Yeah, let me take a look. So January 2nd was kind of a break. It kind of formed this base here, and then it got tight right under the moving averages. In all honesty, I wouldn't have seen this move coming. Hold on, just let it load. On a day like this, with such a strong hourly bar that pours in, I'm not a fan of buying it up here. Instead, I would have simply waited for this to happen. If we got that, then I would have bought it. But since we just moved that higher the next day, then so be it. This is not a good trade in my books. Even though the chart looks good and it's likely going to continue higher, don't really see an entry. Maybe down here, but that's also kind of extended. But I would have looked for this. Just that. And then I'd be buying that. Yeah, maybe. I honestly don't know what Tesla's going to do. It's kind of flat, right? Yeah, FOMC is um, becoming more of a. Can't believe I'm saying this, but a non-event. I've been saying this for quite a few months now, and you'll see it happen time and time again. I can't remember the last time we actually had a proper impulse move on FOMC that led to a big move in the markets. Maybe there's one that I just don't remember, but none off the top of my head really. Instead, what happens is reaction comes out, usually a pop that gets faded, consolidation into the conference, then maybe, if anything, a couple of points pop or sell that eventually gets reversed the next day. Nothing really happens. SQQQ chart definitely did throw me a bit off guard. I was expecting us to reject off of 620-ish. Definitely wasn't expecting a move all the way back up to all-time highs. Did we make? Oh, we did make a new all-time high. I didn't know that. It could mean that the market will sell, yes. I personally do think the market will move lower. It's just up 5 days in a row. And it's getting exhausted up here into all-time highs, which can easily be swept and lower into the next couple of days. But we also still have earnings tomorrow. Apple reports. Amazon, does Amazon report? No. Who else reports tomorrow? Google? Is it just Apple? Yeah, just Apple then. So yeah. Do you guys want to know something crazy? Gold gained a whole apple this week. How crazy is that? What's the gold market cap right now? Yeah, the current market cap of gold is 38.5 trillion. So 10% of that is 3.8 trillion. The market cap of Apple is 3.7 trillion. If you look at gold, weekly gain from last week's close to the current high, that's 10.5%, which is basically 3.9 trillion. That's a whole Apple in market cap being gained in just 1 week of trading. And the craziest thing about all of this is it's coming up here. We're not talking about it coming off of some sort of accumulative base or some sort of kind of move off of the moving averages after it's consolidated for quite some time. No, we're talking about it after it being up 100% in a year. I don't think people understand how crazy this is. That just adds to my conviction of how big of a mean reversion can hit this. It's also why I want to position myself in next week's instead of just one DTEs, because sure, I can catch day one of a 5% sell, but I think this can get a lot uglier next week. So I just want to buy some next week's and see if I can get leeway and then swing them. But yeah, I'm getting ready to hit this with a lot of size. Think I could definitely get a big win. How many days up is this now? 8 consecutive up days. 20% in 8 trading days. That means in 2 weeks we gained 2 apples. What's the market cap of the video right now? 4.6. But yeah, good luck to everyone that's trading this with me tomorrow. Hopefully we do catch them. I certainly think we will. It's end of the week. This is the biggest. Oh, by the way, yesterday, or because I'm in 12 a.m. is already past me, so technically today is a new day for me. But Wednesday, the 28th, was the largest gain on gold futures since March 2022. Fun fact for you there. What does that tell me? More conviction. But yeah, guys, I'm gonna end the stream here. Great talking to you all as always.